Everybody has seen the efficient frontier, risk and reward, and you have the efficient frontier. Bonds are usually down here, stocks are up here. And the interesting thing is you start with bonds, which are a low-risk asset, and as you add stocks to that bond portfolio, something magical happens. The bond portfolio actually has an increase in return and reduction in risk. Now, this to us is quite a feat. Obviously, Markowitz identified this in the 60s, and really quite a powerful topic that I think is misunderstood. And I think that typically in the world, people own a stock and bond portfolio because they feel that stocks respond to different factors than bonds do. So good news for stocks is often bad news for bonds, and vice versa. This provides a bit of diversification. I will also add that asset allocation is a process. The 60-40 portfolio, for example, is a process that you use to get diversification. So asset allocation is a process, and it's a process that we use in order to achieve diversification. So let's dig a little deeper. So properly implemented diversification is something that can really do a great job at mitigating risk in portfolios. So what we have here is Brexit. So this is the day of the Brexit vote, and what we have are varying asset classes that would have been held, and we'll go through how we construct a risk parity portfolio. But the allocation to these various asset classes, you can see that this yellow line here is European equities. They opened up over down 10%. You also had things like gold open that day up over 14%, over 5%. And so if you were thoughtfully diversified, you could achieve the thick blue line. And this is just the tick data from that day. So it was minute by minute changes in all the different asset classes held in the red circle. And if you had held them in this allocation, in the allocation that we held them in resolves risk parity, your outcome that day could have been magically flat. No dislocations, no large losses. And we're going to talk about how we do this and also how you can do it. Recall that asset allocation is the process and diversification is what we want as an outcome. So let's dig a little bit deeper into this idea of diversification. And big fans of Peter Bernstein. In general, survival is the only road to riches. Let's think about that. Survival is the only road to riches. You got to survive the volatility. Your client has to survive the poorest portion of the return stream in any strategy in order to get to the long-term returns. Further, diversification is an explicit recognition of ignorance. And what we mean by that is, or what Peter means by that, is that we just don't know what the future holds. And when we think about thoughtful diversification, it's about preparation more than prediction. So making sure that you're considering all your options, i.e. think globally. If we go back to the Brexit slide, we can see if we think globally and we're holding a series of assets, number of assets, that what happens on Brexit is actually a diversifiable risk. Second is have a thoughtful way in which you put that together, i.e. risk parity is one thoughtful way of constructing that portfolio. And if you do that, you can have pretty sanguine outcomes, both in Brexit or in January and February of this year. If you had returns to your portfolios that were erratic in Brexit or were erratic in January and February of this year, then it's possible, or likely even, that your portfolios were under-diversified. And so let's pay attention to that as we go through this. I would also add there are some diversifiable risks. There's lots of diversifiable risks that we can eliminate, so Brexit being one of them. There are also non-diversifiable risks, and in that I would refer you to a piece we wrote called Risk Parity and the Four Faces of Risk. If you Google resolve risk parity or the blog risk parity and the four faces of risk, you'll find this article. It's on our blog, but it just digs a little bit deeper into the risks that we can take and the risks we have to take and the risks that we can diversify away. So thinking about this holy grail of diversification, at the heart of diversification is correlation, right? So in this chart, we have on the y-axis, the return per unit of risk, i.e. Sharpe ratio, and on the x-axis, the number of assets. Now you'll see up here, we also outline the correlation of the assets. In order to achieve diversification, you want assets that are not that correlated to one another. So you can see down here in this light green line, you can add lots and lots of assets, 10 assets, but if the correlation is very high, 0.9, think I'm going to add 10 bank stocks to my portfolio, all from the same country. Well, that's not going to give you a lot of diversification. On the other hand, if we have assets that have very low correlation, what we see is we can capture a tremendous amount of diversification benefit with 5, 6, 7 assets, as long as their correlations are low. And this is something that we'll expand upon. And stocks and bonds, in the classic sense of the balanced portfolio, are often considered a typical portfolio of 60% bonds, stocks rather, and 40% bonds, and they assume that the correlation is going to be low typically. What we find historically may not actually support that assumption. So consider all your options and think of an assembly process that's balanced and harnesses the opportunity for diversification. Now, we have to understand a little bit more about the markets and the regimes that can manifest. And generally there are 4 major regimes that can occur. These occur due to shocks that are with respect to inflation or shocks with respect to growth. And when we see these 2 levers moving in real time, what they create is 4 distinct economic regimes. So if we think about the inflationary boom, think about 03 to 08, all right? You think about a disinflationary boom, think about the 90s. If we think about a deflationary boom, think about 08, think about the 1930s. That is not very good writing, but we'll continue to attempt to improve that. And then stagflation was the 70s, all right, where you had slowing growth and inflation. And at any point in time, the world exists in these various regimes. And different asset classes, in fact, respond differently in these different regimes. And if we look at this target, we've outlined these regimes. And then as we move from the inside of the target to the outside of the target, we increase the sensitivity to that regime. And so in Canada, in fact, resides over here in the inflationary growth area. As you know, Canada is a petrostate, so it behaves much more like an emerging equity rather than a developed market equity. That's okay. But you can see that these regimes that can manifest will have different outcomes for different asset classes. And now we need to think about, okay, how might we construct a portfolio that thrives in all economic regimes? Well, we're going to look into that. So before we do that, let's take a look at the ubiquitous 60-40 portfolio that we've chatted about. Remember, typically these stocks and bonds are put together because good news for stocks is generally bad news for bonds, typically, and vice versa. And this is the typical allocation that we see, but it doesn't really respond well to all economic regimes. In fact, if we look at the 60-40 balanced portfolio from the period of 1965 to 1990, you can see that real rates of return for a balanced portfolio were actually negative. So that can have some pretty devastating outcomes for portfolios and pretty devastating client outcomes. In fact, stocks returned negative 0.67% real. Bonds returned negative 1.29% real. Consider also that they were correlated. So they were both having negative returns and were correlated, not adding any diversification benefits. So the 70s were characterized by this inflationary shock with low growth environment. But as we observed on the target, and if you paid close attention to that stagflation area, there are assets that thrive during those periods. And they were gold and commodities. Gold and commodities also were not only thriving, but they were non-correlated. This is the magic. This is the heart at which diversification beats. And so we see commodities generated a 12.9% compound real rate of return. Gold, 23% compound real returns. So if you could consider these asset classes and even put them together in an equal weight format, all we've done here is just for illustration to show that there are assets that are thriving. A balanced, diversified portfolio of equal weight of the stocks, bonds, gold, and commodities did exceptionally well. Client outcomes were improved dramatically, obviously, and we can see that while the ubiquitous 60-40 portfolio struggled mightily and had large drawdowns, it did not help clients achieve their goals. Now, I want to emphasize this is just for illustrative purposes.